This is staggering. I'm your host, Steve Metre, and thanks for joining me today. And in our lead story today, Americans continue to rack up massive amounts of credit card debt into a slowing economy. And if you find yourself in that position, we're going to give you some tips on what you can do before it's too late. Plus, Fed Chair Powell's back in the news saying he's going to have to make some unpopular decisions that people aren't going to like. And we've got some more data showing that we're likely to have a recession this year. Let's over to CNBC, where we picked today's story up with a headline: Americans lean more on credit cards as expenses stay high. 6% of cardholders now carry debt from month to month. As the personal savings rate sank near an all-time low, credit card balances jumped 15% year over year, according to the latest report from the Federal Reserve Bank of New York. With prices more than 8% higher than they were a year ago, it's perhaps unsurprising that balances are increasing, as if the Fed doesn't seem to get it. Now, we've made this case before on the show that inflation tends to lead wages, and wages don't go up as much as inflation. So what happens in rapidly rising inflation, workers get behind, and to stay ahead, or at least to try to keep afloat, they turn to their credit cards. And sure enough, we can see in this next chart that wages are not only falling behind, they're starting to slow down. Here you can see average hourly earnings of production and non-supervisory workers in blue against the consumer price index in red, both shown on a year-over-year rate of change. And we can go back even into the 70s and see as inflation outpaced, of course, wage growth, and that was a problem. And you can note here it was again in the late 80s, and what happens each time it leads to a recession. Again, we see this in 2005. While wage growth was fairly strong, inflation beat it, and now look, you see inflation outpacing wage growth. So it's only natural that consumers will have to turn to their credit cards to do it. Now, of course, what they're hoping is that inflation comes down and their wages stay up, which actually does tend to happen. But one of the problems is if we do have a recession, well, workers will find themselves on the unemployment line. The real test, of course, will be to follow whether these borrowers will be able to continue to make payments on their credit cards, as now studies show fewer Americans are paying them off in full. And that is always the story in a debt-based economy, is when does the music stop? And in this case, we note that as the economy is slowing and the likeliness that people are going to lose their job is going to increase, and that's going to put into question when people already are having to deal with high rent costs, high food costs, high energy costs. Are they going to be able to continue making their credit card payments, or are they going to max them out and say, you know what, if I can't get a job, I'm going to let this thing go? And that's what we're seeing. At least the banks are starting to agree here that things, at least that space, are not looking good, which is why they're tightening lending standards. Here you can see the net percentage of domestic banks tightening standards for credit card loans now moving higher, and you'll note that this tends to only happen as we go into recession. Now you might say, well, wait a minute, it led the pandemic, but if we wouldn't have had the pandemic, the probabilities we would have had a recession were increasing. But you can note sharp moves higher, of course, in tightening standards for credit cards leads to a recession, because what does that mean? Well, if you can't get more credit on your card, maybe you've already maxed out, maybe you want another card because inflation's out of control. Well, at some point, if you can't establish more credit to spend, well, guess what? You have a forced stoppage. That stoppage leads to a slowdown in the economy, and there you go. You've got the gray bar recession on the chart. Nearly half, or 46% of credit card holders, carry debt from month to month on at least one card, up a whopping 39% from last year. People are hanging in there for now, but some cracks are starting to show. The average credit card rate is now a whopping 19.6% on average, at an all-time high, after rising at the steepest annual pace ever, in step with the Federal Reserve's interest rate hikes to combat inflation. And of course, you might remember from prior shows where we've talked about this, that when the Fed hikes, it takes about 2 months before that rate hike gets impacted in credit cards where they raise that interest rate. So if you look back to, of course, to December, what we should expect is that to start hitting sometime in February. And if Fed chooses to hike in February, well, that means we're not going to see that hit balances until sometime in May. But let's continue because there is some hope, because I want you to see that even though banks are tightening lending standards, you've still got a shot to deal with this before time runs out. Cards offering up to 21 months with no interest on transferred balances are still widely available. Making the best use of a balance transfer boils down to making those payments on time. And here's the key part: aggressively paying down the balance during the introductory period. So if you're finding yourself in that position, that is fantastic advice, because now that you see that the banks are tightening lending standards, it's only a matter of time before those lucrative balance transfer deals at no interest go away, and you can bet a ton of people are going to want them. And something else everyone's going to want is CTA-Timer Pro. If you're wondering why the tech stocks are driving higher, well, here you can see in our report from today, NASDAQ futures, the machines are short covering, moving up to a minus 15% position, squeezing the market higher. Of course, you want to know what the machines are up to. I'm going to leave the price at $20 through the weekend, and then it's going to 30 on Monday. Get in while you can. 30-day money back guarantee. And now somebody who doesn't have a guarantee on what's going on, well, that's Fed Chair Powell. Powell says the Fed might have to make unpopular decisions to stabilize prices, as price stability is the bedrock of a healthy economy and provides the public with immeasurable benefits over time. But restoring price stability when inflation is high can require measures that are not popular in the short term, as we raise interest rates to slow the economy. And what he's referring to is the fact that he believes not only is he going to continue to raise rates, but he's going to need to hold them elevated for a very long time. Of course, we've looked at the yield curve in recent shows and said, no, that's highly unlikely that he doesn't realize how close he is to a pivot, although we note that Powell's a pretty smart guy and probably does know, but he wants to make sure he lets everyone know that until inflation comes down, he is staying on the job. But what he may not realize is the other casualty of his unpopular decision is going to be layoffs. And here you can see the federal funds rate in blue overlaid with a 4-week moving average initial claims. And sure enough, we can see in a number of periods that when the federal funds rate is rising, the economy slows down and you see a lagging effect of initial claims start to happen. We can note that at some point we might expect this into early next year. Of course, we've said that employers are going to hang on to employees as long as they can, hoping the economy turns around. But if they can't, they're going to lay people off. And of course, that will help with inflation, as we discussed, because as people have less money to spend in the economy, particularly on discretionary goods and services, well, that will lead to prices coming down. And now we've got another indicator that the odds of a recession this year are extremely high. A closely watched indicator of a coming recession is blaring its loudest warning in over 40 years. The difference between the yield on the 2- and 10-year Treasury note is the widest it's been in about 4 decades, flashing a notorious warning of a looming recession and possible sign of more pain to come for stocks. And here you can see the 10-2 yield curve, and you can see this massive inversion that we haven't seen since the 1980s. And I want to point out that here you see an inversion, recession is the gray bar. Inversion, recession, inversion, followed by recession, inversion, recession, inversion, recession. Slight inversion, got a recession due to the pandemic, and now the question is are we going to have a recession? Well, the yield curve says the probabilities are very, very high. It's the steepest inversion since the early 1980s, as I just mentioned, and potential grim omen for the economy, as an inverted yield curve has been a notoriously reliable indicator of a recession in the near term. And just to put some color to what you're seeing, long-term rates such as the 10-year, 20-year, and 30-year are what they're indicating is growth and inflation expectations. So when you see rates on the longer end of the curve fall, what the bond market is telling us is that economic growth is going to slow in the future and inflation is going to come down. So you might be asking then, what's propping up the 2s in this 2-10s curve? Well, that's the Fed. And so as long as the Fed keeps prices elevated, you can see what the curve is trying to tell us here is the Fed thinks interest rates need to stay high, and the long end of the curve says, no, you've got to bring them down. The bond market is discounting the Fed's policy as marginally more restrictive than the end of 2022, and many investors will see this as increasing the odds of a 2023 recession, and history supports that concern. It is noted that inversion in the yield curve, as I pointed out, led to recessions in 1990, 2001, and 2008. The inverted 210 spread doesn't mean a recession is inevitable, but just says the probabilities are increasing. But the economy is now more vulnerable to an exogenous shock, Coles warned, and stocks should brace for some pain as well. It's hard to argue for a strong equity market or valuation when the 2s yield is much more than the 10s, simply because we know this differential signal is inherent brittleness in the U.S. economy. But when we can look back in the past, we can note that when the curve starts to steepen, stocks can actually rally before they figure out that perhaps that's not the right move. But another indication the economy is slowing, we got that today. The crude oil inventory reports, staggering number here. What you see is crude oil inventories jumping up by nearly 19 million barrels. How about that as a sign the economy is slowing? Look at this. We've got distillate stocks only down about 1 million and gasoline inventories up 4 million. So we've got signs that consumers are racking up their debt and the economy is slowing. And the Fed, it seems intent on putting people on the unemployment line. So grab those balance transfers while you can and try to get your cards paid down. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.